I'm Olivia Voznenko.
I'm Steve Guilfoyle, and this is Modern Wall Street.
What? Steven, it's not August. Why are you getting into your birthday suit?
Because the markets have been volatile.
Let's get this rolling because we have an awesome guest. Steven, let's talk markets real quick.
All right, the markets have been all over the place. This morning they were down big. We've had the Fed this week already. We have Jobs Day on Friday. It's been a wild ride. I guess we can chiefly blame inflation, we can blame interest rates, and we can blame trade policy. Or not trade policy, but the expectations that something nasty might come out of these negotiations with China.
Okay, hold on. I'm about to have a coughing fit. That's how I feel about all of that. Let's keep going.
So we don't have a lot of time because we do want to get to our special guest.
Yes.
But I do want to warn the folks out there, or not warn, but in these times you have to play this game with a lot of discipline, and you have to know what's coming. You have to know what you want to do. And the trade I profiled this morning in my morning note, and
what I watched you just trade,
and that I executed this afternoon was a trade in Disney. All right, Disney's been coming in. It's been getting a little weaker. Earnings are on next Tuesday after the close. Right now we're looking for $1.68 on revenue of $14.23 billion. Whispers are about a nickel higher than that. What I did was not initiate because I had a small long, but I increased my long today. It's still rather small, right here in the 98s, around 98.80. That's not the important part. What I really wanted to do was just get in a little bit. I'd rather buy it cheaper. So I wouldn't be really upset if Disney comes in after earnings next Tuesday, which it has been known to do. Actually, it does it almost every time. I think I showed that to you, Olivia. It usually has a little bit of a rough day or two in response to the earnings. All right, what I did to reduce my entry point, my basis, was I sold what's called a strangle. All right, I'll read it out to you.
A strangle?
A strangle, right. It's. I went out a few months here. I went about 4 months into the future. All right, September's the expiration date on these options. I sold 110 calls and I sold 87.50 puts. All right, I brought in $2.65 in total on both sides. For each, I can't say for one contract on each side would be $2.65. So what I've done is reduce my net basis by that much, assuming I have 100 shares of stock. So we just mentioned I paid $98.80 something for my shares. That would basically reduce my net price down to the low 96s, which puts me in a much better position. I'm already short 90 puts that expire, 92.5 puts rather, that expire in a couple of weeks. So I have a good chance of loading up at both 92.5 and down the road 87.50, but we really don't want to see that one go off. That's one we just did for the revenue.
Man, well, we're in a little consolidation mode there. If you get a nice breakout, you made a solid trade. And I like what you did with the options.
Sure, and the reason why I'm becoming so interested in Disney is because in this modern era, the young people, the people even younger than you, Vaz, they seem to be going in two directions with their culture.
Okay,
right?
Two directions.
There's the stay-at-home economy.
What does that mean?
It means that you pretty much become something of a couch potato. You
like
to be entertained at home. You like to order your food in.
You like to
the
play
Netflix
with your cats.
people, that kind of thing.
No one
and we
does
have
that.
the other people who like to get out there and do stuff. They like to go to concerts or to ball games.
Live
or whatever.
life a little.
The experiential economy.
Okay.
All right. Disney caters to both of these groups. All right. You want to go home. You want to watch streaming service or cable television and ordering a pizza. That's them.
Excellent, Stephen. And speaking about the economy, we have an awesome special guest. Say the name.
All right, Danielle DiMartino Booth, well known for her book, Fed Up, which came out in February of 2017.
Guys, she is awesome. Let's get Danielle on right now.
Welcome, Danielle.
It's great to be here. Thanks.
Nice to have you. You know, I first became aware of your book, Fed Up, when it was published in February of 2017, and that's when I bought it, February of 2017.
Valentine's Day, I sent Janet Yellen a forget-me-not.
It's a very easy read, your book, and I would suggest that book as reading material for all the folks here at Modern Wall Street.
Thank you.
It's the kind of book that is written on a level where almost anybody can understand it, and we can almost hear your voice as we read it.
And if you get the Audible version, you can hear my voice.
That's a great idea.
Oh, really? You're actually on it?
Yeah.
I read it the old-fashioned way.
The Audible feedback has been incredible because they actually hear me get angry as I'm going through it, because I get angry all over again.
Very often.
It is an angry book. In fact, I think that was Jim Grant's review of your book. He said you mentioned the word angry.
Yep. Well, look, I mean, The Federal Reserve is a venerable institution. I was extremely proud when I was asked to serve my country. And let me tell you, for what they pay you, you are serving your country. But it was so frustrating after a few years in. Don't get me wrong, working for Richard Fisher, who was kind of the only real markets person, right? Because to me, the Geithner wasn't even a markets person, and he was running the New York Fed. So working for the only markets-oriented president during the financial crisis was such a huge privilege. But being part of an institution that didn't recognize its fallibility in the aftermath of the crisis that nobody saw coming inside the Fed, it frustrated me so much. Because there was an internal recognition that, you know what, we're following the wrong inflation metric, otherwise we might have noticed that asset prices had gone haywire. So they recognized it, and then they chose to do nothing about it, at which point I got really fed up.
Exactly, and that's the title of your book.
Exactly, that's what happened.
Well, it is such an honor to have you on the show, have your inside knowledge, because I think a lot of people feel fed up, but they don't exactly know why. So we're going to get into that, right, Steve?
You got to connect the dots.
Absolutely.
In fact, the Fed, as everyone watching a show like this would know, just released their statement yesterday, their monetary policy statement, and no surprises there.
There were surprises.
Well, go ahead.
There were surprises. Look, this is a lame duck meeting. This is a meeting that Janet Yellen or Ben Bernanke would have made sure that they didn't even cause a ripple in the markets. And I take my hat off to Jay Powell. He had the gumption to really change the language and to say what he would say in the statement. And that's that the difference between 1.9% and 2% is splitting hairs, people. And that's why they made the language about inflation that much more hawkish yesterday and scared the markets.
Well, he did make sure people understand that. He did change the language regarding
with
fixed
no
asset
press conference.
investment.
He's like a big boy.
Yeah, well, that's true. And he's not the only one, I think, that comes from a more markets-based background. I think there's a few economists there now that have worked in other...
Randy Quarles, I
that
mean,
have
he's
other
been on
fields.
planet Earth. Rich Clarida from PIMCO, if he gets through the nomination process and confirmed, I mean, he has studied financial shocks to the system. When I read that about Rich, I said, good, you need somebody on the FOMC who understands how financial shocks ripple through the economy.
Do you have a fear that as the Fed pushes out the short end of the curve, the market isn't really playing ball? I mean, we're actually seeing strength in the 10-year today. Do you have a fear that they will force an inversion before the end of the year?
I think that the 10-year is trying to tell them that they're going to force an inversion. Now, there's a lot of technicals going on. We had record shorts in the 10-year, so there's been a lot of short covering for people who were on the wrong side of the bet. But that being said, the fact that we could only hold 3% for 48 hours, that's, I mean,
right. And the foreign
Big Daddy
central
bond
banks-
market is telling you something, and that's in the face of all this oncoming treasury supply, and this is no longer an inflation scare.
The
This is
Treasury
inflation.
isn't focusing on the long end, though. They've been focusing on the short end, which I find a little odd.
Let's put more pressure where the Fed's putting pressure. Why not?
I don't,
I
as a
mean,
markets guy, I
just
don't understand
throw
that.
fuel to the fire. There's not a lot of coordination after June, after September, if they insist on inverting the curve. And it would be interesting to see any central banker intentionally invert the yield curve.
Well, we saw a lot of volatility in the stock market, but that's not the main focus that we should be focusing on.
No.
It's rather credit, correct?
Look, Treasury volatility is at the lowest in a half century right now. And I mean, what happened with the VIX was frightening, and then the FANG stocks, and I get it. But it was just a little ripple compared to what would happen if we really saw credit market volatility pick up. And Jay Powell understands that. He's seeing that there's no feed-through effect from stock market volatility. Therefore, he's not saying a word about the stock market because it's a lot of noise right now. Look, the market's bounced off its 200-day moving average 3 times now. So there's no calamity to even talk about. If you're like Sarge and you're in the market every day and you're trading, I mean, there's a lot of bumpiness. But the credit markets are very quiet. They're just as quiet as they were last year.
And are you finding that as something that's spooky, or are you like Jay Powell?
Oh, I'm totally spooked out. Look, we had in 2007, we had 7 days that the VIX closed south of 10. In 2017, we had 52 days. So that was so much complacency that I was spooked about the stock market. And so, but we're at the same place in credit, where you feel like the rubber band is getting stretched so tight that there's going to be a volatility event. at some point. And the Fed could trigger that event. Or if we were to have companies continue to talk about their compressed margins. Because this is no longer, the companies are taking it on the chin. When Caterpillar came out and said, this is it, this is the peak, we're getting squeezed. When 3M said, we're getting squeezed. You can't talk about margins getting squeezed and panic buying because of proposed tariffs and not have it bleed into real inflation. The question for Jay Powell, the question for the economy, the question for the 10-year, the question for everybody is there pricing power? Can these prices be passed along?
And
Yeah.
this is the result of perverse monetary policy for more
Absolutely.
than a decade, really almost 20
Look,
years.
this experiment has nothing to do with the lead up to the financial crisis, Zippo, because in terms of sheer magnitude, it's bigger. We didn't have quantitative easing leading up to the financial crisis. We just had really low interest rate policy, and that fed through badly enough with enough bad behavior, in the credit market. And again, it was the credit market that blew up.
And that's where the bubble is now.
Yeah, let's get into the good stuff.
Yeah.
You're saying the Fed is the bubble, the balance sheet.
Well, the central banks, right?
Central banks in the aggregate, we just hit $22 trillion in global QE. That is a big bleep balance sheet. It's a lot of money. 2017, we saw $2 trillion of quantitative easing deployed worldwide. October 2014, the Fed ended its taper. The Fed quit growing its balance sheet in October 2014, and all the cheerleaders down here on Wall Street were saying, look, the stock market didn't fall out of bed. Well, no, the stock market didn't fall out of bed because other central banks actually picked up their quantitative easing efforts after that, and last I checked, money's fungible. Liquidity travels. And that's the one thing that started getting me to connect the dots and really begin to worry, because if you start to study how much of the global credit market, the $240 trillion credit market, is priced in dollars, it becomes problematic. That means that there's the potential for contagion through the conduit of the dollar, because frontier markets that I can't even pronounce the names of the country have issued debt. Companies with absolutely no profits have issued debt. Leveraged loans are a joke on trading floors because there's no protections for investors. So again, it's the magnitude of it and it's the denomination it's in.
Is quantitative tightening enough?
Quantitative tightening will be enough once it's global. And we will be net negative as of next summer. Things will really start to hurt if Mario Draghi at the European Central Bank can follow through.
And he
We're
won't.
50% of the way through the taper. I was shocked that he actually pulled that trigger. We'll know by Labor Day who his replacement is, because Germans are planners, and the Germans have their eyes set on having a German replace Mario Draghi, and the Germans are much more rigorous in the way they approach monetary policy. So will he be pressured to follow through by December and finish the taper?
If the Germans pick the guy, maybe.
Well, again, he's not coming in until next year.
Yeah.
Nevertheless, the greatest risk for me is that Europe, the entire EU, goes through a cycle and still comes out at the other end with negative interest rates.
Well, growth is starting to get a little shaky over there.
It is, it certainly is. The Citi Economic Surprise Index looks like the opposite of a hockey stick. It looks like it fell out of bed.
Well, a lot of people are, some of the headlines are a lot of people are nervous that they're going to tighten into a recession, but that sounds like the least of our worries compared to what you just explained.
Look, I mean, again, the Swiss own our FANG stocks. The ECB owns our corporate bonds, all in dollars. And so, again, there are different levels of connectivity between these central banks because they ran out of things to buy. They're like, we're going to keep this experiment going come what may. I mean, the Bank of Japan owns 80% of its own stock market.
That's incredible.
I didn't know that.
Well, they bought all the ETFs.
They bought all the ETFs.
Oh my gosh.
I mean, Japan is a country where you don't lose face. And the head of the largest stock exchange in Japan a few months ago, at the risk of losing face, came out and said, Kuroda, enough with this. You're killing the stock market. You're crowding out any and all natural buyers. This QE business has got to stop.
I mean, I hate to say it, but this sounds like a joke.
Oh, I mean, it's again, this is supposed to be the lender of last resort, not the sugar daddy who never goes away.
Now,
Well said.
you're obviously, you've identified not only the problem, but the problems. Jay Powell calls you tomorrow and says, you know what, you did a great job when you work with Richard Fisher.
Yeah.
Do you have any ideas here that you could help me out with? Is there a path you would suggest if he'd made that call?
Look, I think that he is the most challenged man in the world. Alan Greenspan once famously said that the ideal inflation rate is 0. I'm right there with you, Alan. In fact, that's it. That's where our agreement ends, philosophically, period. But this 2% target is, it's the silliest, most arbitrary number out there. I would advise him to get rid of the target, get himself as much flexibility as possible, and potentially pray. Because I think that going back to the zero bound, going back to zero interest rates, trying to put enough bullets in the chamber so that you have ammunition to then lower rates, zero interest rates they're what caused this problem in the first place. So I would tell him, don't go back there. Leave it alone.
And don't buy bonds.
And don't buy bonds. QE didn't work either. I mean, QE generated a lot of wealth.
It postponed.
It generated
postponed the
a
problem.
ton of paper wealth. It generated $40 trillion in
And
paper
we're taking
wealth.
some of that back
But
now
I
in the
keep saying
equity market.
paper wealth because paper's combustible.
Right. So what is the picture? Like, when this happens, which you say no matter what, we're going to have a serious situation, they're not going to take your advice.
I think it's when growth stops. After this fiscal burst that we're getting from the president.
But what am I going to see as a person?
Well, look,
as a
you're
person on
either
the street?
you're either going to see a stronger dollar, and that's going to trickle through to all kinds of pain in the emerging markets,
That's going to hurt earnings.
where there's $22 trillion worth of on-balance sheet and off-balance sheet dollar-denominated debt. So either the dollar's going to get stronger and you're going to smoke emerging markets, kill margins here, kill our exports here in the United States, or the Fed's going to tighten us into a recession, and then you're in a recession. So
Which they've always done.
it's like pick your evil, pick your flavor, because there's no real way out from here. And if the Fed's going to insist on increasing interest rates, then it should put more pressure, upward pressure on the dollar.
Exactly. And how are companies going to handle that?
They're not going to like it.
Well, they're going to lose how will corporate debt end up looking? How will high yield debt end up
Oh
looking?
gosh. I mean, look, I think I'm not picking on any particular company, but I think when companies such as WeWorks are able to come to market, really with no business model that can be sustained, and come to the junk market, their original goal was $500 million. They raised $702 million, and this was done last week, and every trading day since then, we've seen the bonds trade down. So typical late stage credit cycle, you see companies that should never have access to the bond market gain access to the bond market, because it's kind of this last hurrah of reach for yield.
I see the documentary now. I really can picture it.
Well, I mean, it's Einstein was misquoted. I don't know who said the thing about insanity, but they said, okay, we've got a problem here on our hands. It was created by an overabundance of debt, so we're going to fix it by creating, even more debt. So I'm like, why did you think that was going to work the third time around? Because we had the .com thing where companies with no profit were floating IPOs, and then we had everybody needs to own a home. And now it's, if you can fog a mirror and you're a frontier country or you're any corporate issuer, you can float a bond.
Well, someone's going to make a lot of money, unfortunately, with this.
Someone's going to lose a lot of money.
So more people are going to lose a lot of money, but someone's
be careful
out
when
there.
the big brokerage houses start devising indices to bet against these things.
Yeah,
That
that's true.
That means they're playing the house.
That's true.
We've been there, and we've done that, and I think we've all lost a job or two along the way.
Yeah, well, and the guy in The Big Short just about lost his marbles,
Yeah, exactly.
but then he made out like a bandit.
Well, that's what I'm saying.
And he has said confidence in central banks is an issue. It's problematic.
Yeah, he just said that at Milken, correct?
Yeah.
He came out to speak for the first time in years.
Yeah.
Well, I think Jay Powell's probably the best chance to reestablish some credibility at the central bank, because I think most people have some respect for him, both from the world of economics and from the world of the street.
Planet Earth.
Yeah, so I do think he is the right man for the job, but as you said, I asked you that question before because I thought, what would I tell Jay Powell if he called me? And I'm like, you know, I had a lot of advice for Janet Yellen and Ben Bernanke, but they never asked. I don't really have a good idea for him.
Yeah.
Because we've gone too far down the rabbit hole.
And that's the problem. You can't unring a $70+ trillion bell, because that's the debt build since the crisis.
And because we tightened the most, does that give us any ammo at all? Or defense?
Well, no, because again, it makes everything offshore that's dollar denominated that much more
That's right.
vulnerable. So there's a feedback mechanism that's so perverse.
It also hurts the dollar, well, strengthens the dollar.
Right.
Which is.
That's, again, but that's
bad
very
for the rest of
problematic.
us. Yeah, that's a problem. Oh, well, Danielle, I wish that I knew the right questions to ask, didn't get the right answers, but I guess we're just going to.
Sometimes there aren't the right answers.
No,
I mean,
actually.
sometimes the stock market is down because there were more sellers than buyers. It's just
I
as
think what
simple
you're
as that.
saying.
I mean,
I think what you're saying is when you eat too much candy, you get a stomach ache.
Yeah.
well, exactly.
And when you have beauties and smarts, you're fed up.
Thank you so much.
Thanks for coming.
Danielle,
I appreciate
thank you
your
so much.
time.
Awesome to meet you.
Thank you.
Really
Likewise.
cool, heavy stuff.
Well, Vaz, it's been kind of a tough week already.
It really has.
And it's not over yet, but the show is.
But remember, Stephen, where's the dog go? To the pound. All right? I'll see you on Tuesday.